What if $50 a week was all it took to quietly build a six-figure portfolio? The mechanism is compound interest. Your returns earn their own returns. Every dollar you make starts making more dollars automatically without you lifting a finger. Since 1957, the S&P 500 has returned an average of 10% per year. That single number is the foundation of every calculation you're about to see. Not a guarantee, but 67 years of history. $50 a week is just over $7 a day. One skipped delivery fee, one fewer streaming subscription, one coffee you brewed at home. The barrier isn't where most people think it is. The investment vehicle here is a broad index fund, one that tracks the entire S&P 500. You're not picking stocks. You're buying a tiny slice of 500 of America's largest companies at once. Here's the myth most people carry. You need a big chunk of money up front to invest seriously. That belief keeps millions on the sideline, watching the market compound without them. Meanwhile, the average American spends $53 a week on restaurant meals alone. That's from a 2023 Gallup survey. The money already exists in most budgets. It's just flowing the wrong direction. So let's run the actual math. Year 1. You invest $50 every single week. By December 31st, you've put in $2,600. Simple addition, nothing fancy yet. At a 10% annual return, that $2,600 grows to roughly $2,860 by year's end. You make $260 without doing anything extra. That's the engine turning over for the first time. Investing weekly instead of monthly is called dollar cost averaging. When prices dip, your $50 buys more shares. When prices rise, you already own shares gaining value. The rhythm itself cuts your risk automatically. By year 3, your total contributions hit $7,800. But here's where most people quietly quit. The balance doesn't feel impressive yet. The chart looks flat. Patience is the hardest part of this entire strategy. But if you stayed in, your compounded balance at year 3 is closer to $9,300. You contributed $7,800. Compounding already added $1,500 on top. The gap is starting to open. Here's what the curve looks like in actual numbers. From year 1 to year 3, compounding adds $1,500 above your contributions. From year 3 to year 7, it adds $18,200 above contributions. Same habit, same $50, but the second stretch generates 12 times the bonus of the first. That's not a feeling. That's arithmetic. Year 5. Total contributions, $13,000. Compounded balance at 10% annually, approximately $17,200. The compounding bonus is now over $4,000. The gap isn't closing, it's growing. The most common real-world vehicle for this strategy is Vanguard's VTSAX, which tracks the total U.S. stock market. Its expense ratio is 0.04% annually. Fees eat almost nothing of your returns. Year 7 is where the curve bends. Contributions total $18,200. The compounded balance has climbed to approximately $27,500. You're now earning more from compounding than from your weekly deposits. That crossover, where your investment gains exceed your weekly deposits, is the single most consequential moment in this strategy. The market is now contributing more to your wealth than you are. You've become a passive earner. But what about crashes? The S&P 500 dropped 34% in March 2020 in just 33 days. If that happened in year 7, would the whole strategy collapse? This is the question that stops most people cold. The S&P 500 fully recovered from that March 2020 crash by August 2020, 5 months later. Investors who kept their $50 weekly deposits running through the crash bought shares at discount prices and captured the entire recovery. Year 9. Total contributions, $23,400. Compounded balance at 10%, approximately $44,000. You've nearly doubled your money. Six figures isn't here yet, but the momentum is unmistakable. Pause for a second. Based on everything you've seen, the crossover at year 7, the $44,000 at year 9. Take a guess. What year does the balance finally cross $100,000? Hold that number. Year 12, total contributions, $31,200. Compounded balance, approximately $102,000. You put in $31,000, the market handed you $70,000 more. The number that should stop you cold is $70,000, the portion of that six-figure balance you never deposited. Compounding generated it entirely on its own. In year 12 alone, the portfolio earned roughly $9,300 in gains, more than 3.5 times what your weekly deposits added that year. The math rewards patience in ways that feel disproportionate because they are. And if you keep going, year 20, contributions total $52,000. Compounded balance, approximately $310,000. The same $50 weekly habit, uninterrupted, has produced $350,000. Here's a question most people never think to ask. Where are you holding these investments? Because inside a Roth IRA, every dollar of those gains, the $70,000, the $250,000, comes out tax-free in retirement. In 2024, the IRS allows up to $7,000 per year in Roth IRA contributions. $50 a week is $2,600 annually. Well inside that ceiling, you have room to grow this habit before you hit any limit. The most powerful move in this whole strategy is automation. Set up a weekly automatic transfer into your index fund and remove the decision entirely. Behavioral economists call this a commitment device. It works because willpower is unreliable and automation isn't. Remember that myth that you need a big lump sum to invest seriously. The 12-year math just dismantled it. The person who started with $50 a week beat the person who waited to save $10,000 first. This is the core of what Thomas Stanley documented in his research, stealth wealth. The person quietly investing $50 a week looks unremarkable. No flashy purchases, no status signals. But their net worth is compounding invisibly while everyone else performs wealth they don't have. Stanley's 1996 book, The Millionaire Next Door, studied 10,000 American millionaires and found the majority drove used cars, lived in modest homes, and invested consistently for decades. The data confirmed what the math already shows. Here's the cost of waiting in actual dollars. Someone who starts at age 30 and invests $50 a week reaches $102,000 by age 42. Someone who starts at 31 reaches the same milestone at 43, but also arrives at age 42 with roughly $9,300 fewer dollars in their account, a gap that widens every year they stay behind. 1 year of delay costs more than 3 times what you deposit that year. Here's the detail most people miss entirely. Of that $102,000 at year 12, more than half, $55,000, was generated in just the final 4 years, from year 8 through year 12. You spent 8 years building the launch pad. The rocket left the ground in 4. That's what exponential actually means when it lands in your account. Open a Roth IRA. Pick a total market index fund. Automate $50 every Monday. And don't touch it, because the most powerful financial move you'll ever make is the boring one you start this week and never stop.